Over a 10-year period, the average American who leases every 3 years will spend somewhere between $60,000 and $90,000 on cars and own nothing. Nothing. Not a driveway with a paid-off car, not an asset, a receipt. And the thing is, the people doing this are not unintelligent. They are doing exactly what the system was designed to get them to do. This video is the math. All of it. Slow, clear, and without anyone trying to sell you anything. Let's start with what leasing actually is, because most people describe it correctly but understand it wrong. When you lease a car, you are not buying a car. You are renting the depreciation. The dealership buys the car. The manufacturer predicts what it will be worth in 3 years. The gap between those two numbers, that is what you pay for. Say the car costs $45,000 new. The residual, meaning what the manufacturer guarantees it will be worth at lease end, is set at $27,000. That gap is $18,000. Divided over 36 months, that is $500 a month before anything else. Then there is the money factor, the lease equivalent of an interest rate. It looks like nothing, something like 0.0125. Multiply that by 2,400 and you get the equivalent APR. 0.000125 becomes 3%. Sounds fine. But you are paying that rate on the full capitalized cost of the car, plus the residual, not just the depreciation you are actually using. That is the first quiet mechanic. You finance the whole car to use half of it. Add in acquisition fees, usually around $900. Disposition fee at the end, $400 to $500. First month's payment due at signing. You also need insurance, and because you do not own the car, the lender requires full coverage, which costs more. And there are mileage limits, usually 10 to 12,000 miles a year. If you drive 15, you owe 25 cents per mile over. 3,000 miles over at lease end. That is $750 you did not budget for. Now you hand the keys back, and you walk into the showroom and start again. This is the part the system is very good at, the loop. You never feel the total cost because you only ever see the monthly number. $549 a month. That is the number they show you, not $80,000 over a decade. $549. Let's do the real number now. 10 years of leasing, 2 lease cycles, the same class of car. Lease 1, $45,000 car, monthly payment $549, 36 months. That is $19,764. Add the acquisition fee, the first payment at signing, and gap insurance the lender requires. You are at $22,000, give or take. 3 years later, you do it again. Prices have moved up. The same class of car is now $48,000. Your new payment is $575. Another 36 months, another $21,000 spent. Fees again. You are at $44,000 total. 6.5 years in, still nothing to show. Now lease 3, you are partway through. At year 10, you have spent roughly $63,000 on cars. $63,000. And when you return that third car, you have zero. Not a bad car with 100,000 miles on it. Not a project car in the garage. Zero. The receipts are all you have. Now let's talk about buying. And I want to be honest about this. Buying a car is not automatically the smart move. It depends entirely on how you do it. Most people who buy finance the car, and they finance it in ways that make leasing look competitive. So let's look at both. Scenario 1. You buy the same $45,000 car. You put 10% down, $4,500. You finance $40,500 at 6% over 60 months. Your payment is $782 a month, higher than the lease. This is the exact moment most people stop calculating and start rationalizing. The lease is only $549. That thought right there is worth tens of thousands of dollars to the dealership. The comparison is not which payment is lower. The comparison is what each path costs you over time and what you hold at the end. 5 years of financed payments at $782 is $46,920 total, plus your $4,500 down. Call it $51,000. But here is what the lease calculation leaves out. At the end of 5 years, you own a car worth approximately $22,000 to $24,000. Your net cost of ownership, money spent minus asset value, is roughly $27,000 to $29,000, not $51,000. Compare that to leasing the same car for the same 5 years. You spent roughly $36,000. You own nothing. The monthly payment was lower. The total cost was higher. This is how the math gets hidden. They shrink the number you see and extend the number you never add up. Now let's talk about depreciation, because this is where the lease math either gets worse or gets interesting, depending on the car. The average new car loses about 20% of its value the moment it leaves the lot. Not a metaphor, an actual transaction cost. By year 3, it has lost 30 to 40% of its original value. By year 5, 50% is common on mass-market cars. This is actually why leasing exists as a product. You are paying for the steepest part of the depreciation curve, the manufacturer's worst problem, and they are charging you handsomely for solving it. The residual value is set by the manufacturer's financial arm. They do not set it to be fair, they set it to be profitable. If they set the residual high, say 60%, your payments are low and the car looks like a great lease deal. But at lease end, they sell the car at auction for less than they predicted. That is a loss they absorb to move product. If they set the residual low, 40%, your payments are high and they sell the car at auction for more than they said it was worth. That is pure profit. Either way, they win. The residual is a number they control entirely. You are betting against a house that wrote the rules. There is a scenario where leasing makes more sense, and it is worth being honest about it. Business use. If you can write off lease payments as a business expense, the math shifts. You are using pre-tax dollars on an after-tax product. High depreciation vehicles. Some cars lose 60 to 70% of their value in 3 years. On those, leasing protects you from the fall. The residual is your floor. Low mileage driver. If you drive 8,000 miles a year, you will never hit the overage. The cap becomes irrelevant and the lease math cleans up. But here is the problem. Most people leasing do not fit these profiles. They drive 15,000 miles. They are not writing it off. They just liked the lower number. And so the loop continues. Every 3 years back in the showroom. Every 3 years, another acquisition fee, another first payment, another residual they set. Now I want to look at something that most of these comparisons skip entirely. What happens to the money if you do not spend it? The difference between a lease payment and a modest used car cost is often $300 to $500 a month. Let's say $400 a month invested in a broad index fund, historically averaging 8% annually for 10 years. $73,000, not from a windfall, not from a raise, from not leasing a new car and investing the gap instead. $73,000 in a decade from a $400 difference. This is the real math that never appears on a dealer's desk. This is not financial advice, but it is financial reality. The opportunity cost of consumption is the most expensive thing you never see on an invoice. Now let's talk about the dealer. Because the dealer does not care which you choose, both options make them money. On a lease, the dealer makes money on the cap cost, the negotiated price, on the money factor, markup, on add-ons like extended warranties and paint protection. The money factor has a buy rate, what the manufacturer offers, and the dealer can mark it up. That markup goes directly into the dealer's pocket. On a purchase, they make money on the sale margin, the financing reserve if they arranged your loan, and the same F&I products. The finance and insurance office, the F&I box, is often where dealers make more per unit than on the actual car sale. Extended warranty on a leased car you drive for 3 years while the manufacturer warranty covers it. That is nearly pure profit for the dealer. Paint protection, fabric guard, nitrogen in the tires, the tire pressure monitoring kit. Each one has a margin north of 200%. And none of this is illegal. All of it is disclosed. It is just disclosed in a room you are in for 90 minutes after 4 hours of negotiation, when your decision fatigue is at its peak. This is the system working as intended, complexity as cover. The more confusing it is, the less likely you are to say no. Now, let's look at the best-case buying scenario, the one that actually builds something. You buy a 3-year-old car. The steepest depreciation has already happened. Someone else paid for it. You pay $24,000 for a car that was $45,000 new. You finance $12,000 after a small down payment. Your payment is maybe $250 a month. You pay it off in 4 years. Then you drive it for another 4 years with no payment at all. 4 years of no car payment. That is $400 a month, minimum, that went somewhere else. $1,000 a month if you'd been leasing new. Meanwhile, the leaser is back at the dealership. Third cycle, another acquisition fee, another first month at signing, another 36 months of building someone else's equity. This is how the math diverges, not in a dramatic single moment, gradually, over years, compounding in the background while life continues. Let's talk for a moment about something people don't usually factor in: the psychological cost of a high monthly obligation. A $550 lease payment is a fixed obligation for 3 years. Lose your job in month 14. That payment is still due. The car is not yours. You cannot sell it to cover a rough month. Early termination on a lease can cost thousands. Sometimes the remaining payments in full. You are locked in a way a purchase is not. A car you own can be sold. In an emergency, it becomes cash. A leased car is a liability that cannot be converted. It is one-directional. Now, I want to address the argument people make for leasing that is actually the most honest one. You always want a new car, you always will, and the lease gets you a new car every 3 years at a predictable cost. That argument is real, and it is worth naming what it costs. You are paying for the experience, not the asset, like a subscription to the feeling of a new car. If you know that and budget for it, and your finances are genuinely strong enough to absorb it without compressing your investing, fine. The problem is, most people doing it are not in that category. Most people leasing new cars are stretching. The payment feels manageable until something else goes wrong. And the car they are leasing is often a status signal, the visible proof of a life that looks a certain way. We came from places where the car was the proof, not the bank account, not the investment portfolio. Nobody could see those. The car said something. I understand this. But the car that signals you made it is often the first thing that makes sure you cannot build on it. The display and the foundation are in competition. The people who grew up without money and built it quietly, they drive unremarkable cars, not because they cannot afford better, because they learned the car is not the point. There is a specific kind of wealth that does not advertise. You have to be looking for it to see it. Let's revisit the numbers one more time. 10-year total, cleaner this time. Lease path, 3 lease cycles over 10 years, same class of car, accounting for price creep. Total spent, approximately $68,000. Assets at end, 0. Buy path, 1 financed new car held for 10 years. Total spent $51,000. Car worth $8,000 to $10,000 at year 10. Net, $41,000 to $43,000. Best path, used car bought at 3 years old, paid off fast, driven long. Total spent approximately $30,000. Net cost after resale, roughly $22,000. The gap between the lease path and the used car path, held and invested over 10 years, is not a small number. It can be the difference between having financial options and not having them. Financial options. That is the phrase. Not wealth exactly, just the ability to make different choices when the moment asks for it. The lease is designed so you never feel the total. Monthly payments are how you buy things you cannot afford and barely notice the cost. That is not an accident. It is not even cynical. It is just how consumer credit was designed, to remove the psychological friction of large numbers by converting them to small ones. The question is not whether the system is fair. It is not. The question is whether you see it clearly enough to make a different choice. Transport is not optional. You need a car. This is not an argument for not having one. It is an argument for understanding what kind of car costs you. The car that gets you there is rarely the car the dealership is pushing. They are incentivized to sell the car with the highest total margin. Your interest is the car with the lowest total cost. Those two interests are almost never aligned. Knowing that before you walk in is worth more than any negotiation tactic in the building.